So, as everyone knows, 2022 presented investors with a number of significant headwinds, and looking like 2023 is going to be the same across inflation, geopolitics, rates. Michael, in your opinion, how did infrastructure do as an asset class?
Well, thanks, Lucas. Lovely to be here, and I enjoyed some of the introduction slides. Thanks, Fraser. I think 2022 was a brilliant year for infrastructure because I think it really demonstrated that unlisted and listed infrastructure pretty much said what it says on the sticker on the box, which is defensive, inflation-linked, robust returns, and both of those asset classes significantly outperformed the listed markets as we know and saw. So I was really pleased when people are questioning unlisted infrastructure valuations and whether they're realistic, for instance. I could just say, well, if you don't believe me, go look at the listed market. Because, the MSCI World Index went down 18% last year. If you look at a hedged version of the S&P Infrastructure Index, it actually went up marginally. It was above water. Whereas there are other indexes like the FTSE, which is used in the Your Future, Your Super Index, went down a little bit. But I think S&P Infrastructure Index is a really good example of a more core-like infrastructure index in the listed markets. And it was up, and a very well-known index, which I cannot name, in the unlisted market, which is used by most super funds for benchmarking, it did A plus last year. So, unlisted infrastructure does have different characteristics because of the nature of the valuation, and particularly because of the nature of we're really in a different ecosystem than the listed market.
Yep.
But I really believe it was a great year, and we're seeing lots of uncertainty again, and I think we can point to the recent track record to really sell both types of infrastructure investment.
And Sarah, from your perspective?
Yeah, look, I don't think it was any surprise to anyone in this room that listed infrastructure outperformed general equities last year. I think my issue, though, is to take a step back because since the March 2020 sell-off, the performance of listed infrastructure continues to lag general equities. And from my standpoint, that's really frustrating. So, it is an equity. We get caught up in equity market volatility. But then when we saw the bounce post the March 20 sell-off, we just didn't participate. So we ended up in 2021 with a significant value gap between listed infrastructure and listed equities. Completely unjustified if you look at the fundamentals that happened over that same period. Listed infrastructure, or infrastructure, I should say, in general, did exactly what it was supposed to do during COVID, and that is give you relative earnings resilience. So we gave you the relative earnings resilience. We saw EBITDA growth. We saw strong maintained momentum through that period, yet we continued to lag general equities, which saw some significant contraction. So, 2022, we saw some of that reversion or that value gap close, but it's still significant. And from my perspective as a listed infrastructure investor, it still presents a significant opportunity as we move into 2023 because we're looking at a similar environment. There's uncertainty around macro, there's geopolitical concerns, and listed infrastructure or infrastructure in general can really stack up well on a fundamental basis. So, yes, while 2022 was okay, it was good relative. You go back a couple of years, we're still lagging, and that's very frustrating.
And Charles, from your perspective?
I sort of agree, Lucas. I don't think we should be high-fiving each other, mate, after one good year. We've had, in essence, the sector's done fantastically well over 15 years, or 10 years at least. A lot of structural drivers have helped that. If the sector did poorly last year, then I think we'd all be questioning the existence of a sector potentially, both listed and unlisted. So it was almost the year that had to happen after what's been a frustrating maybe 3 years more generally. But we could all point to the long-term returns, which are fantastic, and all the other characteristics that I won't repeat to. I was looking at how many smart people there are in this room today. I won't repeat to everyone here, but I think importantly, this year I think will be the real differentiator, the real challenge in an ambiguous environment is when I think those companies with those idiosyncratic drivers may really come to the fore. And I think potentially this is the year going forward where you may start to get real differentiation between listed and unlisted returns. Both positive, I hope, but I think certainly from this year forward is when the real challenges potentially for unlisted relative to listed may sort of come to the fore a bit more aggressively.
And I guess following on from that, can you kind of give us a bit of a steer in terms of where you're looking to invest and where your portfolio is sitting without giving too much away?
I'm more than happy to give it all away. I think importantly, they're easy in our view. Obviously, the European trade was beginning of this year, late last year. A lot of that easy money has been made, certainly in European duration. Our view going forward is that it is going to pay to be a bit more defensive than we have been in the past. And there's certain sectors we can achieve that. But more importantly, as you enter a market historically, as you enter a market where there is a lot of uncertainty around the macro outcomes and the impact that will have, we still think that those companies where you do have those idiosyncratic drivers are the ones to sort of focus on. And it's a market cap of $2 trillion. So there is the ability, even in an environment where valuation appears quite fair in some sectors, there is still the ability when you have a large market cap, and if you're an active manager, to really sort of to find those companies. So I don't think it's going to be the rising tide lifts all boats this year. I think there'll be some real differentiation amongst sectors, geographies, more importantly amongst managers over the next year or so.
Thanks. And I guess, Sarah, from your perspective and kind of a bit more of a focus on EM, are you kind of positioning the portfolio very differently this year compared to last year?
Look, I think infrastructure can be positioned for all points of an economic cycle. I think it's got some great unique characteristics that allow us to position it for defensive or for growth or for whatever it might be. From our perspective, two of those characteristics that we're really focusing in on this year, earnings are underpinned by contract or regulation. So that's a big focus, and an inflation hedge. We are in an elevated period of inflation, and if you capture that inflation correctly, you can compound that into valuations, into earnings, and into pricing. So we are looking for that inflation hedge. We're looking for the quality value underpinned by contract or regulation. At the moment, we're looking to capture that inflation. We are overweight what you guys know as user pays. We are overweight still the real rate utilities because we can pass that inflation through. So that's sort of how we're positioned from a short-term basis. But the point I would also make is that, infrastructure is an asset class that should take advantages of not only the short-term macro, but the long-term fundamentals or the long-term thematics. So we believe those thematics are in play. They're only being enhanced by the current environment. So our portfolio is not just trying to capture inflation. It's not trying to just hedge interest rate risk or recession risk. We're also trying to position for the long-term value that is infrastructure. And for us, that's the continued reopening trade. It should be China's year. So yes, EMs are there. We're still looking at the population growth with the East getting younger, the West getting older. Yes, that's emerging markets. We're still looking at the developed market replacement spend. As you all know, emerging markets and the emergence of the middle class are, I think, something that's a phenomenal investment opportunity. And clearly the energy transition, you can't ignore it. It just continues to grow and gain traction. So these thematics we're still exposed to, but we're also still trying to position for the near-term cyclicals, whether it's geopolitical, whether it's economic, whether it's environmental. We think you can manage infrastructure to capture both.
Thanks for that. And kind of just following on from the volatility that we're seeing kind of this year, Michael, maybe touch on kind of where you're seeing client allocations and are clients still very supportive of the asset class, or they're seeing value elsewhere?
I couldn't not say that it wasn't a growing asset class with plenty of demand. So, of course, I think globally, Australia's a bit ahead of the curve, but globally, I think there's data, Preqin data, for instance, demonstrating that, slowly there is more and more uptake of an infrastructure allocation for global instos. There's still a long way to go compared to where the Australian industry generally is. But I think there's obviously a recognition that a balanced portfolio should have an SAA towards unlisted assets. And I think the story around unlisted infrastructure is, again, and we're trying to get it out there, is the valuations are got very strong integrity. The industry standard, as IFM's been doing since 2008, is quarterly valuations by independent valuers, no internal valuations. And there's strong regard for markets, both the listed market with adjustments for a control premium, which maybe I'll get an opportunity to talk about it at some point later today. And also for transactions. And So I think it's got, there's demonstrable value, and I think, it underpins a stable allocation for investors and investors. And of course, there's a trend towards greener investments. And, we've had the opportunity now to start a low carbon fund in the last 12 months, particularly infrastructure related low carbon. And we've already made 3 or 4 investments in that space: renewables, batteries, biogas. And that'll become a greater and greater allocation for investors, particularly here in Australia. Maybe not so much in parts of the US, depending on what state you're in. But it's generally there's obviously going to be a trend towards low carbon.
Interesting. And Sarah, from your perspective, in terms of interactions with clients, how are they seeing listed infrastructure?
Clearly, I think infrastructure and listed infrastructure should form a part of any balanced portfolio in any market. I think the frustration that I continue to have and the education that is still underway is that when listed infrastructure was a new asset class 20 years ago, when we're still defining it, when we're still telling you how it fits within portfolios, then maybe a 5% allocation was justified. But today, when we're sitting in an environment where I have a universe of over 200 stocks, so over $4 trillion, I have huge sector, regional asset diversity. I've got proven long-term outperformance. I've got proven better yields than general equities. I have a huge growth pipeline. How can someone sit here and tell me that 5% is the correct allocation to that sort of asset class? So for me, that's the frustration, is that it's not the market volatility, it's not the near-term inflation, it's really the opportunity set that is listed infrastructure now and in the future. It should demand a higher allocation within balanced equity portfolios. That's a different question to listed and unlisted. I think they are complementary, but as a standalone listed infrastructure investor here, I'm saying that we deserve a higher allocation.
Yeah, and I think from our perspective, we view the sector as complementary to unlisted. So I think that's our view, and it has been for a long period of time. And I think we've, for lack of a better word, been seen as an unlisted house, but I think we've always been very supportive of listed as well as unlisted. And Charles, from your perspective, are you kind of how are clients kind of seeing your portfolio?
We're quite global, obviously in our reach. On the retail side, in Australia, it's around 5 to 8% is the typical allocation. Probably not too dissimilar in the UK, maybe a bit higher in Canada. In the US, it's nothing. I mean, I think the frustration for us is just how large the US market is and how difficult it has been to get retail exposure to. The surprise market for us is Asia, where there's been quite a meaningful amount of strength on the retail side. Institutionally, it really depends on the client, where they are in their life cycle, but more importantly, what type of unlisted allocation they have. And then you can maybe define the role of listed, a bit more sharply. But there is a challenge, and the biggest challenge now for all of us globally is that cash rates are so high. So that view that the infrastructure sector provides resilience, a dividend yield which grows above inflation, it's great when cash rates are zero. But when cash rates are 6-7% globally, that becomes a bit more challenging. And then the pivot has to be, well, the dividend growth is so high, the inflation pass-through is so strong, so you still preserve your real income. And that's sort of some of the war we're pushing up against in some markets, even Australia to some extent. So that'll be the next sort of education process going forward. But I agree with everyone on the panel that it does sort of baffle me that when you compare real estate assets and infrastructure on any measure, infrastructure is a far superior asset class, pricing mechanism, market structure, demand volatility, every measure. Yet it's that switch hasn't happened as aggressively as we probably all would have hoped for.
And in terms, you mentioned kind of a couple of geographies there from a client standpoint. On the institutional side, given kind of the audience, are you seeing kind of any institutional flows in the listed space?
Are we seeing? Yes, we are. I mean, certainly we've had sort of a fantastic 3 or 4 years in terms of asset gathering, and it's been pretty evenly spread, probably more skewed towards institutional globally. But it isn't defined by one region. It is sort of quite wide. And as part of our overall portfolio, it'd be quite small, inconsequential sometimes. So that education process still has to happen. Has been happening for 10 years, and there's probably still a bit more to happen in terms of just how complementary the two asset classes are. I mean, I was reading a note published recently by Andrew Maple Brown. $1 trillion has been raised in unlisted infrastructure. And a lot's been raised and listed. Well, the number earlier was $150 billion, but it's still over the same time period, still pales in significance. And that's probably the frustration of most listed managers. And while Michael's smiling so much, most of the time I'm meeting.
And Sarah, from your perspective, kind of what are the institutions kind of doing on your side?
Yeah, look, I think institutional interaction has definitely increased post-COVID. You know, through COVID, there wasn't much going on from our space anyway, or in our world anyway. So increased conversations, increased focus back into infrastructure. Particularly post-COVID, we saw a revisit of listed because the value disconnect was so extreme at that point in time. Clearly, our unlisted peers got the valuations correct. We didn't, or the listed market didn't. So that did create that dynamic. So there is increased looking at infrastructure. I guess my frustration is that it seems to be macro-driven. And if inflation disappears or interest rates start coming down, then do we move away from looking at infrastructure again, and particularly listed infrastructure, and ignore the absolute thematic that should see it really be an exciting investment destination, regardless of what the macros are doing.
I suppose the pushback to that, Sarah, is that you've had 15 years of zero negative real rates and no inflation, and the sector's done very, very well. So again, I think that's the challenge in an ambiguous environment, how the sector reacts going forward. Two data points suggest otherwise, but history shows that in an environment where the macro really, was low rates, negative rates, and no inflation, it's probably the golden days in terms of sector performance.
Sector performance, yes. I'm thinking more of allocations.
Of course, yes.
So in terms of those allocations, when allocations dry up because the macro is shifting, that really, to me, is ignoring that fundamental driver of long-term performance, through cycles. So, yes, we've had a great period of macro tailwinds as an absolute sector, but that doesn't mean that the current macro environment cannot add value.
Yeah, and I think from our perspective, Michael, one of the things that we hear all the time is denominator effect. So, is that from an allocation perspective? Is that kind of a message that IFM hears a lot?
Oh, you mean if listed equities is underperforming, then investors
not so much
will be
that, just in terms of general allocations.
Infrastructure,
Yeah.
They'll be overweight. We're the victim of our own success and strategic asset allocation. If when there's a down year in equities, then our investors may become overweight unlisted.
Correct.
So we just need to talk them through the long term. We've always had very small trickling through redemptions because of that factor. But I mean, I think it's we still remain very strong. We did have some redemptions, for instance, through the UK bond market crisis, fourth quarter last year, which we paid on time. But that was a short-lived blip.
And have you seen those investors come back? Or
I'm not sure whether they've re-signed up or not. But quite curiously, we had more new investors in pounds coming in than we had those redeeming, actually, because they're already in our investment queue. So, we are still in a strong shape.
Interesting. A couple of people's favourite topics, take privates. It's kind of been a more of an Australian experience, take privates than globally. Kind of from an investable universe view, Sarah, I mean, the take privates, do you say that as a kind of headwind, positive for you guys, or what?
Look,
how do you say it?
The value disconnect that happened post-March 2020 clearly was a significant opportunity to acquire really attractive assets out of the listed market. We saw the opportunity, and I'd be amazed if no one else had. And clearly we saw M&A tick up. And I think the last universe rewrite we did, we lost 30 stocks to sort of M&A. And to be honest, if you have a well-managed, high-quality, long-dated, pure-play infrastructure asset that is trading below fair value, it is a takeout target. And that's not going to change wherever it is in the world. Clearly, Australia has more open registries to date, so that's probably made it a little bit easier. But saying all that, I've still got a universe of 200 stocks, $4 trillion with huge sector, regional asset diversity. So if you put that as a starting point, and then you consider the amount of money that needs to be invested in infrastructure over the coming decades, then my universe is just going to grow. So yes, we're seeing take privates. Yes, it can be frustrating to see, you know, high quality assets disappear out of the listed market, but you can't blame the acquirers for that. They got a great deal, but that's not going to see listed infrastructure disappear. We are just going to continue to grow.
I heard you saw a lot of benefit from my firm's takeout of the Sydney airport. You wouldn't say no, would you?
No. No, I wouldn't say no.
And Charles, from your perspective, I mean, are you saying the investable universe grow, shrink, stay the same?
Well, it's growing organically. No, I think it's great when companies get taken out, provided I own the company that's taken out. I think it's a really good thing because it's another data point that can validate our view on valuation. And obviously, Australia's been sort of the forefront of that. But I'm sure there's going to be a whole bunch more going forward. I don't think when you have a persistent gap between transaction multiples and valuation multiples, you know, only three things can really happen. The first thing is that Michael and his team take you over. And that's obviously happened a few times globally as well. You know, the second thing is that listed companies just sell non-core parts of their businesses and they get really exceptional valuations and they reinvest that money into their high quality assets and they generate all those wonderful characteristics. The third thing is, and I think it's where we are now, if you're ambivalent to how you want to hold the sector, just given the more structural headwinds of leverage and rates, and given the pricing differentials, then it's maybe a bit of a unique time just to get a slightly higher return in listed, just by virtue of your lower entry price. And that's sort of our view of where we are right now in the cycle. Not to suggest that you won't get a great return in unlisted, but it just feels like the stars are aligning more in terms of medium-term valuation outcomes.
Yeah, and Michael, from your perspective, kind of how do you?
What are you taking next?
Yeah, well, we don't mention Atlas, but kind of from your perspective, kind of how do you view kind of the take privates? I mean, do you obviously you see kind of the listed markets as a happy hunting ground and have in the past? What's your perspective on
Yeah,
that?
so I mean, every manager, unlisted manager will say we don't like to compete in open auctions. So of course, the listed market is a good place to look for deals. And also, of course, it's about having a team that's got a great network and finding those quiet deals. And they could be buying a piece of a business off a listed infrastructure company, for instance, some sort of carve up. So, you know, relationships and the listed market will be, you know, a good source of deal flow. You know, I was mentioned before, control premium. So, I mean, I think when I joined the infrastructure space, one of the first things I was asked to opine upon was the liquidity premium, which benefits listed assets, and the control premium that benefits my space. And are they both, you know, material? And I think from where we sit and our experience in the ecosystem of the unlisted space, as distinct from the ecosystem of the listed space, which there is an overlap, but they are really different, have different characteristics. I think that the control premium is very highly valued. And even if you have a minority stake, as long as you've got some governance rights, and that will attest to why there is a premium for that market versus the listed market. So you know, if we can see value in a listed stock, when we look at the control premium and where we see, you know, take a long-term view, we take a long-term view on the macro, so risk-free rates, the valuation firms take a relatively long view on risk-free rates. That helps us support our valuations. And it's pretty much industry standard with the unlisted space to have that sort of methodology support the valuations, and that's how we can justify paying a premium on take privates.
Yeah, and maybe following on that valuation, Bent, maybe kind of Sarah, your perspective on that sticky discount between kind of unlisted and listed multiples.
Yeah, look, I think Michael's pretty much said it all. There's definite ways that the unlisted and listed look at the valuation of assets. I think we're using the same methodology, but there's different equity risk premiums, potentially different management premiums. Their access to information and their due diligence timeframes is a little bit different to ours. And we are going to see there is definitely always going to be a value disconnect. It's just when it gets too extreme where I can understand the unlisted market looking at the listed space and saying, that's worth paying up for. And as Charles mentioned, it's great if you own it and it gets taken out, except you lose what you consider to be a great asset. And if you do get fair value, then that's fine. And I think a great example for me is the Atlantia-Abertis deal, the M&A there. We, at the time, owned both. And I think the question was, you lost out on one side because clearly they paid a premium or whatever it might be. Now, that's not a take private per se, but it's that sort of deal. Now, Abertis, we sort of valued that deal at the original bid at about 5 or 6% return. We wouldn't have owned it for that. But if you're an Atlantia borrowing at the time at 0 to 1 to 2% and you're getting a 5 to 6% return on your asset, that still makes sense. So we found that sort of deal as a dynamic of how the different parties will be thinking about that acquisition. We wouldn't have owned Abertis, but we were happy for Atlantia to pay that.
And Charles,
valuations are always challenging, Lucas, irrespective whether you're a listed or unlisted investor. I suppose what I've noticed over the last 15 years in my previous life in unlisted was the concept of the liquidity premium. So think about the control premium, because the control premium, naturally, whether it's infrastructure or any asset, when a private company takes a listed company over or a listed company gets taken over, you pay a premium. But when a direct company, which is already controlled by someone, gets taken over by another direct company, then that's where the concept of a control premium and the premium of having an asset not show as much beta, that's sort of where I get a bit concerned. I mean, in equity markets, there's no such thing as a liquidity premium anymore. It's like an illiquidity discount you apply to your return expectation. I think sometimes the simplest answer is the right one. You've had a huge amount of money raised in unlisted infrastructure. And in a perfect world, every time an asset is acquired, it's done through relationships or not. But a lot of these assets are done in open tenders. And there's 10 other IFMs or 8 other IFMs, exceptional at what they do, all really smart, great teams behind them, all trying to find a home for their money. And there's not many assets out there. And similar to like Sydney housing prices last year, there is just that upward pressure. Sometimes it's not a function of valuation, it's not a function of anything really, it's just a function of just the weight of money. And that's where I think, in my opinion, I could be, maybe it's a bit controversial. That's where I think the bulk of the discount of the difference in transaction multiples and listed trading multiples. And obviously, when a listed company gets taken over, it gets closed up right away because of the control premium. But when a direct company is taken over by another direct company or direct investor, that's when I think there's much more uncertainty in terms of how that valuation is sort of achieved and how it can be sort of justified going forward. It's probably somewhere in the middle. Yeah. We're probably too low.
And I think most managers, their discount rates are not dissimilar for a similar risk profile investment. It's about the business plan, how aggressive it is. And I guess we get to that control premium, see how much do you think you're going to juice up the business when you take it over. But
we rely on management. We have to rely on the management of the company we're acquiring. You can shift that and change that dynamic.
Yeah. And there's clearly some CapEx that it's not going to be done by the listed market, right? When some of those Australian utilities got taken over, just the ability to take them private and bring forward all that CapEx, which the listed market may have priced on a high cost of equity, there's an immediate gain for that as well. I still don't think that explains all of it though.
And just, I know probably got a couple of minutes left. Michael, in a couple of words, you excited for the year ahead?
Yeah, we've got capital to deploy. And I mean, I think the thing that we've been, IFM was maybe a little bit slow in the unlisted space to get into digital compared to other maybe core plus managers. We're now seeing core type investments in digital. We've done 2 take privates in 12 months. The other one, which people probably don't know about so much, is we took out a US listed data centers owner based in Las Vegas, Switch.
You've been on the site visit yet?
Yep. So I'd love to. And so data is an exciting space for us to look. And we are looking at fiber in Germany. The other one, as I mentioned, is again low carbon. And there's heaps of opportunity there. Very competitive If it's the wind farm space, super competitive. Solar, very competitive space. But, again, we saw an opportunity to take a piece of a listed stock and, it was a private market deal in a way, still slightly listed. But we've got to look for those opportunities that aren't competing for one, 5 bidders looking for one wind farm. Yeah.
Sarah?
Excited for the year ahead. I'm excited for the decade ahead.
Okay.
So.
Charles?
I am excited, mate, for the year ahead, but I'm equally as excited about look around the room and, the best infrastructure managers in the world all, within a stone throw of each other, which is a great outcome for Australia more generally. But I do think that the best years are ahead of the sector, thematically, on the idiosyncratic side. But there is still a process of education. And like Fraser, I would hope in, 5 years' time that all our funds have doubled. And I think it's really possible.
Got a couple of minutes left. Were there any questions from the audience? Peter, so you're taking some notes?
So firstly, thank you to Michael. 1 second. Thank you to Michael for attending. I mean, we're a friendly infrastructure bunch, but also a hostile listed bunch. So thanks for showing up. It's been said that I like Charles's point on the ability to sell non-core assets from our listed companies into the unlisted market at better than expected prices, and through that process they can delever and improve the quality of their business. So there's good signs that listed infrastructure is becoming higher quality over time. In contrast, it's been said that in the unlisted market, simply because of the weight of money, they've been forced to go from core to core plus to opportunistic and becoming less quality. Would you respond to that one?
Oh, well, I think end investors need to be discerning on who they're going to put their money with, of course. And, I don't want to do another sales job in IFM, but, we've got 25 years of track record. And we don't think we've moved the dial much on the risk curve. We've always said we've got core funds, Australia and global. But we range, between core plus and to super core, because we've got regulated utilities and we have, toll roads in Mexico. So I think, a balance is diversity. I'm sure everyone here recognises that. But you've got to, be meticulous and stick to your principles. And a strong manager with a track record will do that and not stray.
Any others?
And I've got Greg Conway breathing down my neck. There we go.
They're just in the back.
I'll be recording.
Just give us a bear case. I mean, all good and well. Throw a bear case at us.
So a bear case in terms of sector returns?
Yeah. Next 10 years are going to be great. Off to the races. Give us another side.
Obviously, within the 10 years, there'll be sort of ebbs and flows. It's a listed market and you can't ignore the realities of that. I think not the bear case, the case that sort of challenges us is that there is a huge amount of money that needs to be spent to decarbonise. And listed companies may shoulder that, but someone's got to pay for it. So at some point, that affordability equation needs to be considered. And what impact does that have on long-term asset-based growth of a lot of these businesses? And how do regulators react to that as well? You've seen almost stubbornly high ROEs in North America, really transparent, almost mechanical regulatory outcomes in developed economies. How does that change when the equation is really stacked up against the user of the asset? And that's more of a medium-term bear case, though. That's something which is a challenge, I think, on a 3 to 5 year view. But within the sector, there's always stocks, individually, which are having issues and cost overruns, and all of us saw it and felt it in some of the companies we own. But I don't think it should derail the fact that on a longer term view, the fundamentals are still so strong, even structurally and thematically. Notwithstanding the volatility will be there by virtue of the fact that there is a beta, equity beta.
No one's mentioned the R word yet, recession. I mean, I think
recession's
no one looks forward to a recession,
if you,
a deep global recession.
I think it's great. I think a recession, out of all of us here, every single person in this room, maybe not personally, will do no better at the sector level, provided we position correctly, if there's a good old-fashioned recession in this country. I think the portfolios will do very well, and the characteristics of a sector, the resilience, the defensiveness will be so much on display. Potentially, that's when we can phrase a double our FUM if that happens. And history shows that even in a recessionary environment, you would know, airports, toll roads, they're a big challenge, but certainly not the end of the world for these businesses.
I'll give you a bear case. The last 3 years, we had a global pandemic, we've had a war, and the sector survived and actually flourished. The fundamentals were solid. They continued to give you a resilient earnings growth. Yes, airports suffered, but they came back. So you can, as Charles said, there's ebbs and flows. There's ebbs and flows in every cycle. Yes, there will be a recession over the next 10 years. Yes, there will be, lots going on over the next 10 years. But if we can survive the last 3 years, lockdown for 2 years, war and energy crisis, and come out stronger because of stimulus, because of fast-tracking investment, because of inflation coming back to market, and because of a recession, then I'm not too worried about the next 10 years.
Excellent point.
Perfect. All right. I think that takes us up to 3.